Provision for relief in respect of double taxation. Presentation by Prithvi, MCOM Final, MPM Government First Grade College, Karkala. Meaning, double taxation refers to the phenomenon of taxing the same income twice. Double taxation of the same income occurs when the same income related to an individual is treated as being accrued, arising, or received in more than one country. The article studies double taxation relief according to Section 90 of the Income Tax Act. Here, double taxation of the same income occurs when the same income related to an individual is treated as being accrued, arising, or received in more than one country. Double taxation avoidance. When the central government has entered not an agreement for granting relief of tax or for avoidance of double taxation, the provisions of the Income Tax Act in relation to an assessee to whom the provisions of the agreement apply will apply to the extent these are more beneficial to the assessee. In this, to mitigate the double taxation of income, the provisions of double taxation relief have been created. So, the double taxation relief is accessible in two ways. One is the unilateral relief, and the other is bilateral relief that we discuss in later. So, here the government of India has signed double tax avoidance agreement, a bilateral treaty with over 150 countries to provide double taxation relief to Indian citizens and residents. Here they're provided with two explanation. In that first one is the charge of tax in respect of a foreign company at a rate higher than the rate at which a domestic company is chargeable shall not be regarded as less favorable charge. And the other is specifies territory means any area outside India which may be notified as such by the central government. Claiming double taxation relief. All claims for double taxation relief should be made as soon as possible after the correct liability to overseas tax is known. Claims are usually made with your personal income tax return when you declare the income, but may be made later if the liability to overseas tax is not confirmed until a later date. For example, a UK personal self assessment tax return does not need to be filed until 31st January, which is at least 3 months after the date you would need to file your Isle of Man income tax return. So, while making any claim for double taxation relief, it is important that evidence is provided to confirm the amount of tax paid overseas. Such evidence may be in the form of a certificate of tax paid, a copy of the overseas tax assessment, or other confirmation of the tax paid from the relevant overseas tax authority. Next is how is relief against double taxation provided under the Income Tax Act. Relief against double taxation can be unilateral or bilateral. In that first one is unilateral relief. Section 91 of the Income Tax Act 1961 provides for unilateral relief against double taxation. According to the provisions of this section, an individual can be relieved of being taxed twice by the government, irrespective of whether there is a DTAA, that is a double taxation avoidance agreement between India and a foreign country in question or not. However, there are certain conditions that have to be satisfied in order for an individual to be eligible for unilateral relief. So, when the central government has not entered into an agreement with the foreign government for the grant of double taxation relief or double taxation avoidance, it grants unilateral relief if the following conditions are Satisfied. Let's see the conditions one by one. The individual or corporation should have been a resident of India in the previous year. Here, the assessee is resident in India during the previous year. The income should have been accrued to the taxpayer and received by them outside India in the previous year. The income has accrued outside India and it has not been deemed to accrue or arise in India. And the third condition is the income should have been taxed both in India and in the country with which there is no DTAA, means double taxation avoidance agreement. That means the income is liable to be taxed in India and a foreign country with which India has no agreement for relief or avoidance of double taxation. And the fourth one is the individual or corporation should have paid tax in that foreign country. That means the assessee has paid tax in such foreign country by deduction of tax at source or otherwise. Here, the assessee is entitled to the deduction from Indian income tax payable by him of a sum calculated on such doubly taxed income at the Indian rate of tax or the rate of tax of the foreign country, whichever is lower. Next is bilateral relief. Bilateral relief is covered under Section 90 of the Income Tax Act 1961. It offers protection from double taxation through a double taxation avoidance agreement. This type of relief is offered in two different ways. Here, when there is an agreement between two countries, relief is calculated according mutual agreement between such two countries. So the type of relief is offered in two different ways in bilateral relief, that is exemption method and tax credit method. Exemption method, the exemption method offers full and complete protection from being taxed twice. That is, if an income earned outside India has been taxed in the relevant foreign country, it is not subject to tax in India. That means under this method, income and taxed in only one country, income is taxed in only one country. A particular income is taxed in one of the both countries and exempted in the other country. For example, for the income from dividend, interest, royalty, and fees for technical services, source rule is applicable in treaty with Greece, Libyan and United Arab Republic. And the second is tax credit method. According to this method, the individual or the corporation can claim a tax credit or deduction for the taxes paid outside India. This tax credit can be utilized to set off the tax payable in India, thereby reducing the assessee's overall tax liability. That means under this method, income is taxed in both the countries. Relief is granted in the country in which the taxpayer is the resident. For example, Mr. A, an Indian resident, has received salary from a US company for job in US. Finally, to conclude, thus by utilizing the provisions of double taxation avoidance agreements and relief measures offered under the Income Tax Act, individuals earning income from other countries can minimize their tax liabilities and avoid the burden of double taxation. Thank you.